technology M&A scene may be taking off in 2014's second half. And joining us now here at The Deal is Mounir Gad, who's Silicon Valley Bank's Vice President. Thank you for taking out some time to chat with us today. One of the areas where we're seeing PE firms jump into deals, and I think a big example of this is the Beats deal, which netted Carlyle a huge return. Private equity firms are jumping more into the late-stage venture arena. And it also seems like maybe there are more firms jumping in there, too. What are you seeing of private equity firms that are now going into these super growth plays?
Yeah. Thanks, John, for having me on. You know, it's funny, as it relates to private equity doing more late-stage venture deals, you know, I wouldn't characterize it as a trend, per se. I would characterize it as private equity firms being flexible investors, and that's really, you know, the inherent strength of the asset class. You know, there's plenty of dry powder resting with private equity firms. As of Q2, there was 175 billion with U.S. private equity firms in dry powder, and deals are scarce. They're far and too few in between. There wasn't, you know, as you raise more money, there was not a linear progression in terms of number of deals.
Okay.
And so what you get as a result are valuation challenges. And that's not to say that private equity firms aren't staying active. I think, you know, it's the opposite. Private equity firms are very much staying active and finding ways to deploy capital. And what we've seen at SVB is really a couple of different things. I think first, we're noticing that private equity firms it's kind of a shift up market. They're doing upmarket deals, larger deals, with the idea that, you know, it's somewhat of the same amount of work and the same thesis as it is with smaller deals, just with larger dollars, more zeros. And so, you know, for example, if I have a 4x return on a $50 million investment versus a 2x return on a $750 million investment, it's the same work, it's the same thesis, but it's simply larger dollars. And I don't have to hit a home run, right? I could, you know, there's a 2x exit versus a 4, 5, or 6x exit is still economically sound, and the numbers still work, just with the sheer quantum of dollars. So, you know, that's kind of one thing, is the shift up market. I think you then have the inverse, which is private equity firms moving down market in an effort to deploy more and more capital, as opposed to whale hunting. And the second thing I think that we're seeing is private equity firms taking more and more of a minority stake in companies. In 2013, 39% of all private equity-backed deals in the U.S. were minority.
Right.
In 2012, that number was 33, and in 2011, that number was 25. And what we're seeing in 2014 is that continued trend, an increase on a percentage basis of you know, more and more private equity firms actively seeking out minority stakes as a means to get their foot in the door. Interestingly, I think one of the shifts we have seen is historic, you know, venture capital firms that have historically focused on growth and late-stage investments, focusing more and more on control and majority stake investments, which has historically been exclusive to just private equity firms, but we're starting to see venture capital firms do more and more control deals as well. So, you know, it's interesting. At SVB, our vantage point really does play a role. I don't know if it's because we focus solely on technology, or if it's because we're in the middle market, or both. But oftentimes, you know, our companies, our clients, straddle both venture capital and private equity. So, you know, I wouldn't say it's a trend per se. I would say maybe, you know, perhaps it's just a reminder that, you know, private equity firms aren't the big jumbo LBO firms that you see on the cover of the Wall Street Journal, and they're really, you know, smaller, nimble, flexible, and creative investors that are actively finding ways to deploy capital and balance their return objectives.
And tech sector deals are kind of creeping up right now. What, I guess, wasn't attracting strategic buyers before that's making them jump into the markets now compared to, you know, 12, 18 months in the past?
Yeah, you know, tech sector M&A is certainly creeping up. For Q2 14, it was $87 billion in the U.S. in tech sector mergers and acquisition, which is an 84% increase from the same quarter in 2013, and a 5% increase from Q1 2014 on a quarter-over-quarter basis. So it certainly is getting more and more active. You know, as it relates to strategics and why it seems like they're doing more M&A and they're more involved in the deal, I think it's interesting. I agree. I think that for so many years since the recession, we saw strategics focus on tightening expenses, cost control, all those kind of good things to drive EPS, because frankly speaking, it wasn't coming from top line growth. You know, you fast forward to present day, and what do you have? You have an economy that's in a much healthier state than it was. You have the recession seemingly far behind us, and companies are now turning their focus to growth. And they're finding it inorganically, and they're doing so with by adopting kind of a buy versus build strategy.
Right.
And so it's really interesting that even the equity markets are rewarding this and finding value in this. In 2014 alone, Strategic's stock prices averaged a 5% increase the day after announcing acquiring a target, versus, you know, that's pretty incredible, because that's a reversal from a negative 1.9% average stock price the following day after announcing an acquisition just 5 years ago. So quite a shift there in the pendulum. So, you know, all told, yeah, is it harder for private equity folks to win mandates given the increased competitive landscape? Sure. You know, strategics are healthier. They're being enabled by a healthy equity market, balance sheet cash being at record highs, and a you know, a friendly interest rate environment. So the competitive landscape is certainly there for private equity firms, but that's not to say they're not staying active. They're finding ways to win deals, you know, albeit tougher and more competitive to win an acquisition mandate. And they're also staying very busy with portfolio companies, both through recapitalizations and through the sale of their portfolio companies.
And do you think maybe even for private equity firms who are in the space that right now the attractiveness of these deals is giving them maybe an opportunity to get preferential terms from lenders?
Yeah, it's a good question. I think, you know, again, at SVB, our focus is in the middle market. So the big, you know, jumbo tech deals that we see on the cover of the Wall Street Journal, we're not actively involved in. But certainly there's a lot of capital chasing very few deals. And so what we've seen that translate to is, you know, lower pricing and jumbo-like structures. And one way to kind of quantify that is by looking at covenant-light deals.
Right.
Covenant-light deals in Q2 14 hit $122 billion. That's a staggering number. That is nearly double the previous record high, which was the 2007 pre-recession record high of $68 million. So that's all cov-light deals. But what's more, and what's really interesting to me, is that cov-light deals totaling $200 million or less, i.e. the middle market, saw cov-light deals at Q2 total $214 million. That's 21% of total volume. And just to give you a little bit of context, order of magnitude, last year that number was 11%. So we're certainly seeing that, you know, creep down from the jumbo market down to the middle market. But, you know, at SVB, again, focusing exclusively on tech, exclusively on the middle market, we're certainly feeling that downward leakage from the upper market. But, you know, we're staying disciplined in our approach and adhering not only to the standards of SVB institutionally, but to those of the regulatory bodies and the government agencies, which clearly and concisely, you know, mandate and explain the need for, you know, very strict underwriting standards and valuation methodologies and the like.
All right, and it sounds obviously like some lenders are probably hoping that the deal scene gets a little bit more robust. Mounir, thank you very much for joining us here at The Deal.
My pleasure.
I'm Jon Marino. We're going to bring you more M&A from the tech scene all year on our publication.